Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. If you've been following my channel for any length of time, you know that I believe that we are repeating the sins of the 1970s. You know that I believe that inflation, and more importantly, stagflation, is likely something we are going to suffer in the next decade or so. Unfortunately, stagflation is one of those things that is hard to say we're in it, right? Stagflation means high inflation, low growth. But when are we really in stagflation? There's this index that was really popular in the 70s. It was called the Misery Index. So what I'm going to do here is share with you some numbers, some actuals from the 1970s. And then we are going to look at where we are today. Because again, stagflation means high inflation. Last CPI print was 7.5. And slow or low growth. However, what does growth mean? Is it nominal? Is it real? What is all of that? So the Misery Index actually looks at unemployment. The unemployment rate, or U3. Basically, if the unemployment rate is going up, it impacts the Misery Index in a negative way. And if unemployment is going down, it is obviously reversed. So let's look at some actual numbers from the 70s, and then we will fill out the rest of the decade and then jump to 2021. So first off, I filled out 1972 to 1977. You can see the Misery Index score here in red. So 72 was 8.6, 73 was 13.6, 74 was a bad year. It peaked at near 20 at 19.5. So again, remember, it is CPI. So in 74, CPI was 12.3. This again was an oil shock, right? You may have heard or read about gas lines and odds and evens on license plates and things of that nature. But again, you saw CPI 12.3 and the unemployment rate at 7.2%. So again, add those together, you get 19.5. It does fall a little bit in 75 to 15.1, 12.7 in 76, and then 13.1 in 1977. So you can see in this 6-year period, CPI jumped quite a bit. It jumped from 3.4 in 1972 to 12.3% in a 24-month period. So let's do us a quick favor and let's complete the Misery Index scores for the 70s here. We'll do this here. So in 78, it was a score of 15. 79, it jumped again, 19.3. 1980, 19.7. 81, 17.4. And 82 was 14.6. Again, these are totals, so we need to break down the CPI and the unemployment rate and see which one was perhaps more impactful. So if we go to 1978, the unemployment rate was 6% and CPI was 9%. Again, CPI is back on the uptick. 79, unemployment rate again was 6%, but now CPI was again 13.3%. 1980, right? That 19.7, a peak, at least for this period. CPI was 12.5%. There's a point there. And unemployment rate went up to 7.2%. This is starting to be when the Fed is getting aggressive with rates and trying to break the back of inflation. That, of course, caused, for CPI to be broken, so it starts to fall. Pay attention, but unemployment goes up. These are the big fears, right? When the Fed does what they have to do, they have to break the back of inflation, unemployment is going to go up. And then if we finish this out in 82, the unemployment rate, 10.8%. But congratulations, you broke the back of inflation. This is why it's the misery index. Inflation is not good. And the only way the Fed could break it is force a recession. Look at this. We start 72 at 3.4% CPI. We go on a wild ride that peaks in 79 at 13.3%. Unemployment, really, I think low was 4.9% in 73. It goes all the way to 10.8%. The 70s were not fun. So let's look at where we are today. 2021, 2022. So we have unemployment rate at the end of 2021 was 3.9, and it's 4% today. CPI, right, the other part of this was 6.9% at the end of 2021. It is now 7.5%. Sorry, just putting the caps on these things. So now we are at 10.8% at the end of 21, and today we're at 11.5%. Folks, what we have to watch for with this misery index, CPI, is it going to get worse before it gets better? My guess is it gets worse. Unemployment, Fed tightens. Businesses need to lay off. Where do we go with unemployment? Unemployment's interesting. You know, I talked to you about an economist that basically says we may have a year, 9 months, a year, 15 months, where unemployment goes down, right? The service sector takes off. If that happens, CPI is going up because wage inflation will take hold. This misery index is something to watch. We are in double digits. It probably should get concerning. I mean, just looking back at the 70s, anytime it gets over 12.5. So we're not quite there yet, but we're close, right? It was single digits for a long, long time, right? Unemployment sub 6, inflation sub 2. We were really below 9% for a long, long time. So again, it's concerning. I think stagflation is out there. I'll say that if we get to a misery index of 12.5, maybe 12.7, we are in the era of stagflation once again. And that puts the Fed in a really tough box. Stagflation is nearly a worst case scenario. They can't lower rates for growth because that will impact inflation. And if they break the back of inflation like Paul Volcker, unemployment rate spikes. Look at this. Paul Volcker breaks the back of inflation. Look at that number right there. Unemployment would go up 150%. It would go, I don't know if you can see that. We'll make it bigger. 10.8%. That's what we're looking at. Paul Volcker gets serious, or Jerome Powell gets serious about breaking the back of inflation. It's going to slow the economy down. A slower economy means more unemployed. Not good. Jerome Powell, the Federal Reserve, you stayed too low for too long, and now you're trapped. All you have is bad outcomes. Not good. So track the misery index. It's something we could look at every month together because unemployment rate is reported once a month, as is CPI. So it's something we can track together. We'll get concerned when it gets over 12.5. Okay? Take care, everyone. Have a great day. Bye-bye.